let's begin with Nigeria. Now, of course, that budget, of course, is going to be announced later on today. But we're going to focus, or rather kick things off with the consumer goods sector. And Chapel Hill Denham has a new report that they've actually put out here. And that report basically states that Nigeria has the most attractive consumer goods market on the African continent. They're forecasting that profit margins are going to rise. They're also saying that operating expenses could outpace inflation in the new year, and they're also pointing out some downside risks. Our guest is with us, joining us now. We're going to have a discussion. Boluwatife Ishola, who is a consumer goods analyst with Chapel Hill Denham. Boluwatife, you're welcome.
Thank you very much.
Good to have you. Have a seat. Let's have our conversation. It's good. Very much looking forward to this because consumer goods. There's so much going on. So, I guess. To kick off, your report talks about the rebound in the consumer goods sector. And I don't know if I can pin this on one thing, but can we say that foreign exchange stability has been the number one reason why the sector has rebounded, or are there others?
So I think it's one of the major reasons why it has rebounded. You know, seeing how that in 2023, we had FX devaluation of about 48%.
Yep.
In 2024, it further devalued by about 41%.
That's right.
And so these companies that had dollar-denominated liabilities and imported inventories saw their Naira numbers skyrocket, which impacted their profitability. So now that the Naira is stable, it has eased the pressure, but that's not it. You know, the companies also took action. For example, we saw a company like Cadbury, you know, convert a $7.7 million intercompany loan to equity. We also saw international breweries, you know, enter the capital market to raise 588 billion naira to settle outstanding loans. And other companies did the same in order to reduce their FX exposure. So while the Naira stability is a good one for the sector, we know that other actions have, you know, accelerated the rebound.
All right, fantastic. All right, now, you've got a number of charts in the report, and one of them talks about the pass-through effect. Basically, when I say pass-through effect, actually, I should clarify that, that essentially the companies have been passing through, these price increases or rather expense increases on it to consumers. So yeah, they have the chart up there for our viewers. So yeah, talk to us about that.
So yes, it's true that they have passed prices to consumers. And because consumer goods sector are not regulated like the telcos who have to wait for regulators to approve price increases, they were able to leverage these price increases to cushion the effect of the FX losses on their books. And they did that and it worked for them. But that was not the only thing they did, because if they had increased price without maintaining volumes, we would not see revenue growth. But what they also did was to bring about product innovation in order to protect their volume. So we saw them introduce, you know, smaller store-keeping units. We also saw them introduce like varieties. We saw Nestle introduce Golden One 3-in-1, and we saw all of that just in order to protect their volume. So yes, there were price increases, but they also were innovative with their product to protect volumes.
Thank you for that explanation. Very nice. It really makes things very clear. Okay, next chart. You point out in your report that operating expenses could, you're not saying it should, but you're saying the operating expenses could grow faster than inflation. So explain the I guess why that forecast there. Why do you think what's going to be the trigger for OPEX to expand beyond inflation in 26?
So 2023, 2024, 2025 partly was just survival years for these companies.
Yeah.
They were just trying to survive. But if you look at the books of these companies, you see that we're already at the tail end of the recovery. So now it's growth. They're looking forward to growth, and that means there will be fiercer competition for market share.
Yeah.
And when that happens, we're going to see increase in marketing spend. We're also going to see increase in distribution expansion. And we've seen that start to happen. We saw in Nestle that they have spent 2 times more on advertising in 9 months of this year compared to the same period last year.
Oh, wow.
We also saw that Guinness announced that under its new ownership, it's going to expand distribution of its non-alcoholic offerings to the north, which will increase logistic costs. So we see that other companies will start to come up with things like this in order to get their products in the faces of consumers, get it close to them where they want it and at the price that they want it. So we see, and we expect operating expenses would increase because competition is going to be fierce.
Yeah.
And it's who the consumers can see and can get that they will buy from.
Gotcha. Now, okay, so just to follow up on a prior point about passing on costs. So if these OPEX increases are going to rise, then, I mean, would we expect that to be passed on then?
No, I don't think so.
Yeah.
I think 2026 is going to be about volume growth.
Yeah.
I think that's the focus. They've already passed down price increases.
Those prices, okay.
Yes. And what I really believe is that, despite the deflationary pressures we've seen in the Nigerian market, Nigerian consumers are still price sensitive. So in order to compete, consumer goods companies are going to have to be competitive on that front as well.
Right.
So they would just focus on volume growth in order to increase their top line instead of price increases. Okay.
Now, all right, our audience is a business audience, but still, just, I guess, we're going to talk about EBITDA now, which for our viewers, I don't know, it's these earnings before interest, tax, depreciation, and amortization, right? A profitability metric. Your report says that the firms have basically been able to maintain steady EBITDA margins, and we're seeing the charts up there right now. How have they been able to do that?
It's all about efficiency initiatives.
Yeah.
So we've seen how that, they have come up with initiatives in order to reduce cost. Backward integration is a major theme, but from what we know about backward integration, the process is quite slow before you start to see results.
Yeah.
So what some of these companies have done is that they've accelerated local sourcing by raw material substitution. So instead of waiting for the backward integration process to play out, what they've done is, for example, Unilever since 2022 started locally sourcing sorbitol made with cassava starch instead of importing sorbitol made with corn starch. Nestle in 2024 announced that it was substituting cassava starch, it was substituting corn starch for locally produced cassava starch. Yeah. So we've seen them just say, you know what, we're going to use what we have in Nigeria to make these products. We've also seen some initiatives in terms of on the energy front as well, particularly with Nigerian breweries, which has signed a PPA to transition 2 of its breweries, that's the Lagos and the Enugu breweries, to 100% renewable energy in order to avoid or reduce the exposure to volatile diesel costs. So we see that it's just efficiency. Okay,
so that same chart at the tail end for our viewers watching, at the very extreme right end, the lines go up, all right, and it seems like you're forecasting, I think in the report, 20% growth for EBITDA margins. But if I combine, well, if you're also saying that OPEX operating expenses are going to outpace inflation, isn't that going to pressure EBITDA or no?
So yes, it will put pressure on EBITDA, but we believe that revenue will do the heavy lifting here. Okay. So while EBITDA, while OPEX rather would grow by, will outpace inflation by, growing by about 21%. We believe, or we forecast, that revenue will grow faster at about 39%. Okay. And then it will be able to balance things out and see improvement in EBITDA margin.
Great. Let's get to the stock market. Love talking about that. I think as of yesterday, we're up about, I guess, 46% year to date. But looking particularly at consumer goods, I like these two. This is one chart, but we decided to split it. So we're looking at the market cap for consumer goods, which is, I guess, dark, brown, compared to industrial. So industrials are at 35%. You had oil and gas, about 3, others 14, banks to the left there 21, consumer goods at 27%. And then if we fast forward to 2025, okay, perfect. Consumer goods is now the largest, 23%. See telcos at 21, because of course we had, rebasing. 20, industrials 20, banks 16, and others. So can you talk about the, I guess, trigger behind the increase in market capitalization for consumer goods, and is that in any way tied to any one particular company, being outsized compared to the rest? What was the trigger?
So consumer goods, right? In 2015, that's 10 years ago. Yep. We saw it at 27%, second to industrials, like you said. But now, because of new listings, new sectors, we didn't have the telcos there before. Right. We didn't have the power sector there before. Right. So because of this, it has diluted, the entire market and has shrunk its size to 23%. So that is basically what we've seen happen. And yes, you're correct. We have Bua Foods, which is the number 1 capitalized stock on the exchange in that consumer goods index. Yeah. So when we look closely, we'll see that, when you exclude Bua Foods from the consumer goods index, the consumer good will represent just about 9.4% of the entire market from a market cap perspective. So yes, there's a concentration risk there from a market cap perspective. That's just the story.
Yeah, it's like Nvidia and tech stocks over in the United States and how much it makes up of the S&P 500 and Nasdaq and so on. All right, so you've also got, I really enjoyed this report, by the way. Well done to you guys. It was very informative. I loved reading it. Still on the exchange, you've got another chart. Yeah, I love this. I really love this particular chart. So you're showing here for our viewers the NGX, which is in brown, and then the consumer goods index, which is in black. And then you've also pointed out at the top there, NGX consumer index has outperformed the all share index for the past 5 years. And then you've compared it there, consumer versus ASI, year to date, 1 year, 3 year, 5 year. So I guess, what's driven that? And also, do you forecast that trend is going to continue going forward?
So one thing to know about the consumer goods sector is that it's defensive. People are going to eat all the time, right? And because of that, we're continuously going to see growth in that sector. But one thing we would like you to note is how that, this growth would continue in the near term. This outperformance will continue in the near term. However, there are some risks. One thing I would like to point out is that there are some near-term catalysts. For example, full-year earnings will soon be released, early next year. And Q4 is usually the strongest for the consumer goods sector.
Season.
Exactly, revenue high and everything. And the market is expecting impressive performances. And honestly, in the past few days, we've seen investors positioning for these results. So we expect that to cause a bit of a rally in the market. We also expect that the MPC will take a dovish tilt next year, which should lower borrowing costs and then support capex growth. So that should cause some rally in the market. But the downside risk exists, and it's important to note them. 2026 is a pre-election year.
That's right.
And typically we would see that there is pressure on the dollars, demand for the dollars, political spending, as well as capital flight, right? And if that happens, we may come back to the position we're at again with FX losses. But again, I believe that the recent happenings would mean that the consumer goods company are better positioned to handle another bout of that. Another downside risk to note would be, if we see the Naira, the exchange rate appreciate or remain stable, and imported goods may become competitive once again. And now they are fighting for the same market share. So those are downside risks. But we believe that there will be an outperformance. It will be likely subdued because the market has fully priced in the recovery. When we look at the PE and EV to EBITDA, the market has priced in the recovery. But now we're just expecting to see steady growth of the sector.
Gotcha. And then PE, price to earnings, and then enterprise value to EBITDA. Okay, that great report. I just want to get your thoughts on two recent news bits in the consumer goods space. I guess one of them would be this whole Sachet alcohol ban discussion that's been going on with NAFDAC, the regulator in that space. And I guess the legislature just recently said there's going to be like a stay of execution for now on that ban, so they can't delay it. And I know there's a whole shrinkflation conversation with, how breweries, players are able to, sell their alcohol. So what do you make of that development on that front, on the whole sachet sales thing?
I think this new development, first of all, the sachet alcohol is simply for market penetration. Right. If you can get it in smaller quantities, then people are able to buy it. Right. But what this new development brings is some sort of certainty. Right. It means that there will be volume stability for, those companies that produce alcohol in sachets. But just looking ahead is the fact that investors want certainty with regulations. So this whole back and forth that has been happening for the past couple of years.
Ban it, don't ban it, ban it, don't ban it.
It's been a lot in the market. But for now, what we're going to see is that there's a sort of certainty to it now, and that volumes are going to be stable for now. Okay,
great stuff. All right, and then one more. And we did cover this on show, but I just want to get your thoughts of it. The consumer analyst. PZ Cussons reversing its decision to, I guess, exits from the African markets, and talking about, I guess, a more bullish outlook from the company. What did you make of the decision, and I guess the reasons it gave, and so on and so forth?
So I don't think it didn't come as a surprise at all. Seeing as what we wrote in the report, how that it is Africa's most attractive consumer market. We've seen So for PZ, for example, has, brands that are number 1 and number 2 in their segment. And, in the report, it said that it accounts for 80% of the revenue from Nigeria.
Yeah.
So we've seen that Nigeria is a strong market, given our population, given the demographic, and given the rate of urbanization as well. And they are not the only multinationals saying this. We've seen, increased commitment and confidence in the market from other, multinationals like Toleram, for example. We've seen with the acquisition of Guinness, and other, infrastructure spend in the economy. We've also seen that from Coca-Cola, who said that they've spent $1.5 billion in the past 10 years and plan to spend another $1 billion in the next 5 years. So that's renewed confidence in the market. And, these companies are not just going to invest in a place where they don't think there's value for their money. So I don't think it comes as a surprise. And I think it's a good move for us, at least in the country as well.
Hey, Boluwatife Ishola, Consumer Goods Analyst with Chapel Hill Denham. This was incredibly informative. Thank you for enlightening us on the consumer goods sector. You guys at Chapel Hill Denham, you're doing great work. It's a great report. I encourage everyone to download it and read it. And come back again sometime to talk to us. And wish you happy holidays and Yuletide season.
Thank you for having me.
Thanks for your time.